Hey, Andrew here from Learn How to Trade Online. Welcome to part 2 of 6 of this free training series. And in this video, I'm going to go through and explain why a lot of the stuff that's taught in the old school textbooks, particularly around trend and identifying trend, is just plain wrong. It's overcomplicated, it doesn't work, it looks great in hindsight, but doesn't work in real time. So I'm going to go through and explain exactly how I identify trend compared to how it's taught in a lot of the old textbooks and a lot of the free websites that you see online. So on the screen in front of you, I've got a basic daily chart. It's the euro pound, and I've used this for a good reason because I've got an upward trend to work with and a downward trend to work with and a nice change in trend. Now, you already know that in a lot of the old textbooks and free websites, they always bang on about in an upward trend, you must have higher highs and higher lows, right? Higher highs, and you must also have the lows getting higher as well. Okay, so if you've seen any of the old textbooks, you've been on any free website, that's one of the main ways that everyone says you should look at trend. And it's rubbish. Because the institutions know what's in all the old books. They know what a lot of the content that's pumped out online. I can tell you right now, if you do that, it looks great on the chart in hindsight, but it just doesn't work in real time. Now let's go through an upward trend first of all and look at that. And then we'll go through this downward trend and look at that as well. So the upward trend here, we can see we have moves that go with the trend, moves that go against the trend. And the stereotypical advice is that you must have higher highs and higher lows. Now that does work to a certain extent, but it's flawed, fundamentally flawed, because while in areas like this we do have higher highs and higher lows, identifying the low here is not particularly easy. But look what happens through here. We're still obviously moving up, but we have a double-legged pullback here. Now that means that through this weak upward trend at the beginning part of this chart, you'd be trading. And at this point here, where the biggest move happens, you wouldn't be in the trade. Purely because you've got a lower high and a lower low, which means the market's not going up, yet that's exactly what it does. Okay, we pull back down again, and off we go. The point I'm trying to get at here, this is a really clean upward trend, so I deliberately picked this chart to make it as much in favor of the old school way of doing things. When we go and look at some of the other charts, you'll see this really doesn't work. So looking at the cycles themselves, in hindsight, I'm sure any textbook would have said, okay, you've got cycles here. Any of those free websites would have picked up on this, that have pulled it down to there, and then have very neatly drawn it in to make it fit their style. Okay. The point is that in real time, you'd have seen this like that. All right, you would not have seen a major high, major low. You'd have seen this as being the dip. And if you'd have followed the old school advice, the old way of doing things, you'd have ended up buying here, getting triggered into the trade and losing. And then you'd have missed out on the trade that you really wanted to be in. Okay, if we flip it upside down and look at a downward trend now, I'm sure if this chart in 10 years time was used as an example by a lot of the free websites out there and stuff, you'd see they'd highlight it like something like this. Right, they'd point it out and say, wonderful downward trend, should definitely be trading. They'd point out the lower highs. They'd point out the lower lows. And I'm sorry, but that might work looking back at a chart, but that's rubbish. Because in real time, that's nothing like what you actually went through. So in real time, the way you'd have identified this, you'd have seen the first move down in the pullback, and obviously the beginning of the downward trend starts right up here. Now, to be fair, I was short through there, but for entirely different reasons. I wish I was still short now. But point is that was the very beginning of the market. I had no idea that was a whole new change in trend there. But you have a move down, you have a pullback. You then have the next move down, followed by a pullback. The next move down, followed by a big pullback. And here's the interesting point. You would definitely have seen this as the highs getting lower. you would have wanted to have sold through here. And then after this very small move, as soon as price popped up to this point, you would not have traded this, which again is the biggest move on the chart on the way down. You would not have traded this because you didn't have the lower highs and lower lows. All right, whereas that's the trade that you really wanted to be in. Now, similarly from there on the way back here, rather than just having a perfect pullback like this, that's not the way it happened. We had a pullback, a leg down, a pullback, a leg down, a pullback again before it finally made its mind up. And that's the whole point I'm trying to get across to you here is you can't just look at trend as higher highs and higher lows or lower highs and lower lows. Because while it might look good looking back at charts, it just doesn't work in real time. And really real time is all that matters. Now, the way that I identify trend personally, I use 2 moving averages, I keep it super simple, and one of the biggest reasons why I use a couple of moving averages is because the 2 mentors that really got me profitable 10 years ago, 8.5, 9 years ago, they've now been trading for 35 odd years. In fact, one of them was the first person to make more than £1 million in a day for Goldman Sachs. So, pretty cool claim to fame on his part. But they said straight away that a lot of the stuff that's written in all the old books is useless. They said that they'd coded it, they'd tested it, none of it worked. They said the higher highs and higher lows theory is useless, forget about it. And both of them had come to the conclusion that either you eyeball it, and you use your eyes to identify the trend, which isn't very easy to test for, or B, you use moving averages. They said everything else they tried to put up against moving averages never returned the same quality of trend. So the 2 moving averages that I personally use are an 8 moving average, and that's that yellowy gold line. And I also use a 20 moving average, which you can just make out there, 20 EMA, mine's in the blue. So 8 moving average in the yellow, 20 moving average in the blue. Now, it's very, very simple. I'm sure you've heard of this before. When the 8's above the 20, upward trend. So my point is through here, all I am doing is buying. No ifs, no buts, no maybes, no thinking about it. I am in buy mode all the way through that chart. Moving averages cross over, fine. I immediately change and now I'm in sell mode. I'm not trading the crossover of the moving averages, that doesn't work at all. All right, but as soon as it crosses over, I'm now got my sell hat on. I'm purely looking for short entries into the marketplace. Now, that might seem very, very simple. So let me just go through and look at a few other charts so you can see for yourselves. Let's pick on the best case scenario. Let's pick on something like the NASDAQ. Okay, so zooming out through here, you can see moving averages cross over. I see that as an upward trend. Moving averages cross over, I'm actively looking to sell. They cross over again, I'm in buy mode. All the way through there, they cross over again, I'm in sell mode. I keep it that simple. Okay, go and pick up on a different market, oil now. Exactly the same approach. Moving averages cross over, I'm in buy mode all the way through here. Crossover again, I'm looking for short positions. Crossover again, I'm looking for buy positions. Crosses again, I'm looking for shorts. Crosses again, I'm looking for longs. Crosses again, I'm looking for shorts. The simplest stuff is what works. You do not want to overcomplicate it. There's a huge temptation to add more indicators. There's a huge temptation to overcomplicate trading. Look at harmonics, look at Ishimoku, look at loads of different support and resistance levels on your charts. There's a huge temptation to, as a beginner or a struggling trader, I think you're missing that piece of the puzzle. Well, let me tell you right now that the cleaner your charts are, with just as much price action as possible and nothing else, all right, or maybe a couple of moving averages, the more likely you are to make money. If you go and add on 10 different indicators, you're never going to make any money. All right, the more busy your chart is, the more indicators that you have on your chart, the less profitable you're going to be, the more likely you are to lose money. So, and bearing in mind, I've been doing this for 10 years now, and I've been profitable for 8. So the first 18 months for me were probably what you're going through right now: blood, sweat, tears, pain, trying to get profitable, hitting lots of different dead ends. It was only when I had my mentors really step in and help me that 6 months later I was profitable. All right, so it makes a big difference having help. Now, with the moving averages that I use there, 8 and 20 moving average, I use those because I've coded and tested, and over the years, through just live trading experience, worked out that they produce the highest returns for the charts that I trade. Now, let's look at the cycle theory again over here, and let's just use this upward trend and this downward trend. Now, the old school theory says that you need to have higher highs and higher lows. I don't care about that, okay? Because on this upward trend, if you're marking out the highs and the lows, great, you trade here. But then all of a sudden you get a lower high at this point and you would not be trading there, which, as far as I can tell, is the biggest move on the chart. Okay, whereas little old me here, moving averages crossed over, I'm in buy mode all the way through there. And yes, I'm going to lose a trade at the end of the trend. It's going to happen. Okay, but moving averages cross over again, off we go. Now, this is a lovely example through here of a downward trend. But as you can see, if I squeeze it up a little bit, for how often this actually happens, more often than not, you have far less clean of a trend. Another good example over here, just move it back slightly. If we just go and look at this section through here. All right, so if you're using the higher highs and higher lows theory, I'm sure in a lot of textbooks they'd draw it something like this. They'd make it look absolutely perfect. The trouble is in real time, that's not what happened. I know I keep banging on about this, it's important that you understand. So through here you actually would have identified this way. All right, and you'd have never traded down here, which is where you needed to trade to get the big winner. All right, fine, you'd trade here, you'd make a winner. And then you'd probably still be trading here. You'd take the loss through there, but you wouldn't be there for the cleanup trade that makes all the money. Okay, so you have to be aware that the old school principle of higher highs and higher lows just does not work in today's markets unless you're trading the NASDAQ on a weekly chart or a monthly chart, in which case, fair enough. But that's the biggest and the best trend that's, if I zoom out a bit, that's ever been, pretty much. Since 2009, all it's done is go up. So you can get away with higher highs and higher lows in a market like that, but the simple truth of the matter is that does not happen most of the time. So if we go and look at a different market now, say Euro-Yen daily chart. All right, through here, I'm a buyer. Through here, I'm a seller. Through here, I'm a buyer. Through here, I'm still a seller. I don't overcomplicate it. All right, good example just over here for you. If you stuck to the old school theory of higher highs and higher lows, you'd probably buy here, lose, and then you wouldn't be there for the winning trade. Whereas you use my principle of just keeping it simple, one moving average above the other, yes, you would definitely take a trade here and lose. It's going to happen. But you're also there for the cleanup trade because the moving averages are still the correct way around. You're still there for the big winner that pays you back more than this one cost you. All right, so hopefully you took something of value from that video. And what I want to say as well is underneath this video, you'll also see an orange-red button. If you like what you've seen so far and you'd like to learn more about my Ultimate Trader program, click the button underneath this video and you'll see exactly what's involved as to how I can get you profitable in 90 days or less. I teach you how to day trade 1 minute charts. I teach you how to swing trade daily charts for long-term wealth creation. I give you trade alerts. There's loads of stuff that I'm going through there that's beyond the scope of this video. So click the button under this video right now. Take a look at the Ultimate Trader program. Decide for yourself if you want to come on board. And just remember, 72% of my members are profitable inside of 90 days, which is huge.